So tonight we're going to talk about trading terminology, and it can be very easy to get sucked into the trading world and think that it's for people in the city, for bankers, for traders, but essentially the lingo and the language that's used in any trading scenario, any kind of financial scenario, it's just words. It's just more ways of interpreting the same kind of thing. So I'm going to go through some trading terminology tonight, some a bit of the lighter side of trading, really, just get an understanding of what the basics are, what these complicated terms actually mean, and again, just getting you used to what other traders will talk to themselves about, or what other news wires will kind of say, and how they present it will be in this trading terminology. So before I start, as always, a risk warning. Remember, the spread betting and CFD trading can high risk your capital, result in losses that exceed your initial deposit. The being suitable for everyone, so please ensure you fully understand the risks involved. The information comments provided here under no circumstances or offer solicitation to invest. Nothing herein should be considered investment advice. The information provided is believed to be accurate to the date it is produced. Education only. The content of the webinar is personal opinion of the moderator, not intrade.com. Content does not constitute financial investment or tax advice. Intrade.com does not accept liability for the content comments made during this session. So when it comes to trading and the lingo that's used, it's often much more complicated than it needs to be. But if you go to a financial advisor or you speak to people in the city, you want to think that they know more than you. So the way they do that is by using, complex terminology sometimes. Where there's money to be made, again, it pays to sound intelligent, even if you're not. A lot of the people that I've met in the financial world are not actually that intelligent, but, they do talk the talk. I guess there's no reason why any trader of any level can't be able to understand what's being said by experts or market commentators. After all, they are people trying to convey an idea, and just the way they say it, the way it's structured, shouldn't mean that you don't have access to that information. I guess that's the thing I teach in trading. It's always good to be prepared. Knowing about trader talk, knowing about the lingo, it's just part and parcel of being involved. Again, if you want to go out on the golf course, there are certain terms, certain things that are said, and it's just prudent. If you're going to play golf, you should get to know the language that's used. If you're going to trade the markets, well, then you should understand what financial terms mean. My rule of trading really revolves around this 80-20 rule of trading, and that means that 80% of the time traders are making their calls or talking about technical studies, and 20% of the time this is fundamental. There's a lot more trader talk from that 20%, even though it's a smaller area for me. But obviously, technical trading in itself will have certain elements and certain parts of the lingo that can be complicated. So if you're talking about an indicator, with a scale, then it becomes an oscillator. But all that means is an indicator like Bollinger Bands or Fibonacci or RSI, is a technical study that we use. But then if you're talking about the RSI as an indicator, that's an oscillator because it has a scale between 1 and 100. So it's not more complicated. It is an indicator. It does show overbought and oversold, but it's an oscillator because it has a scale. Now, again, might sound a little bit complicated off the bat, but realistically, when you boil it down, it's pretty simple. That all the things that we use, in the technical side will have their own terminology and terms, and everything from the fundamental side will be that news driven. It will be, for instance, macroeconomics or kind of, it'll be ideas around bullishness, bearishness, Brexit, for instance. All the kind of implications of Brexit are all fundamental reasons. We're going to have more difficulty shifting our exports. We're going to have higher unemployment. House prices will come down. Well, show me the proof. There's no technical proof on these things. These are fundamental ideas. So how it breaks down. Trader talk really is defined by two sides. And there's also generic, I guess, and general economic and political terms that are useful to know about. So as I say, the fundamental side is anything to do with news, anything to do with opinions. Technicals is your charts and anything you use from a graphical perspective. Then you've got the economic terms, which are your bullish, your bearish, anything to do with Brexit, as I say, that's a very hot topic right now. And then political, again, it is slightly more for the political side, when politicians talk about the ramifications of Brexit, for instance, they'll be talking on economic terms, but they'll generally be saying it from a political kind of point of view because most politicians are not economists. So again, there will be a difference in the way that they package and phrase this data. So fundamental trader talk is where it all begins. What are fundamentals? Well, as we've said, it refers to news, data, key speakers, anything that happens outside the technical sphere of trading. There is though, especially with quants, a very technical side to this. If you talk to any kind of quant, their opinion, and quants, anyone that's got a maths degree involved in trading, what they say is they can fade out fundamental movement and the fundamental ideas. So I mean that again, by its very nature, it's some trader talk being able to fade. If you Google fade out, you only really get Radiohead's album coming up. Fade out is a technical term used by traders to say that you try and get rid of volatility, movement in the markets, and noise by fading out what has been said. So you're trying to dampen the effect of these fundamental moves on the movement of markets. So again, that fade out again is just another example of trader talk. If you're talking to someone in a forum or listening to a webinar, or somebody says, "Well, I just fade out that noise because it is just noise in the interim," and especially if you're talking about the Brexit kind of referendum, then you might be looking at cable. You might be talking about the pound against the dollar. Any movements will be short-lived until we get the results of the referendum. So again, all these things are examples of trader talk. So the basics of trader talk are really kind of broken down to a bull or a bear. So when we talk about bulls and bears, we all understand really that that premise that good news comes from bulls, bad news comes from bears. Again, I'm not sure exactly why it is bulls and bears, but I mean, I'm sure we could easily find that out. But what we're talking about is bull markets offer a positive run, bear markets offer a negative run. Then we're talking about fundamentals. We're talking about people within the markets. Your Mark Carneys, your Mario Draghi, Janet Yellen. Now they refer to news in the terms of dovish and hawkish. So it's just the same. If somebody comes out as particularly dovish, they're quite positive. So dovish is bullish, yeah, positive. Hawkish is bearish and it's bad. So when we're talking about markets, direction, bull or bear, when we're talking about people's opinions, people's comments, then that's hawkish and dovish. So again, all relates to basically good news or bad news. So the policymakers don't just come out and say what they want, what the market wants them to say. They always generally code and are quite guarded in what they say. And I guess this is a form of trader talk. So if you're listening to the Fed minutes, for instance, Janet Yellen just doesn't come out and say, yes, we're going to put interest rates up by a quarter basis point next month. It's generally a whole statement, a whole series of ways these things are said and phrased in order to give them to the market. And what we have to do is kind of pick the bones out of it to understand exactly what point they're trying to get to. So Mark Carney, Mario Draghi, Janet Yellen, they're all masters at this, and they will never come out and say things that they know will affect the markets directly. They will phrase things in a way that lead the market to get to its conclusions, but they have to come up with their own understanding. It isn't that Mario Draghi will come out and say, yes, sell the euro. It's again, these policies are a lot more kind of complex, and the way they're phrased is certainly a lot more complex. So understanding the importance of the terms hawkish and dovish, you have to remember that policymakers, will generally have a stance. So this is the kind of thing that really comes into its own when you're trading fundamental news releases, and you're trading any kind of comments that are made. That people like Janet Yellen, Mark Carney, etc., will have a certain stance. So we're quite hawkish from Mark Carney about the Brexit. He's come out quite publicly and said that the UK will go into recession if we leave the European Union. Now, he's a smart guy. I'm not going to take that away from him. But does he really know what's going to happen? I mean, you tell me, over the last 10 years, has anybody really picked out what was going to happen and seen it through? No. Is Mark Carney going to be the one that kind of, cuts through all the noise and cuts through all the ideas, and he's absolutely right in everything? I very much doubt it. As soon as interest rates go up, Mark Carney's job is done, and he'll be fired and he'll back off to Canada, because that's what he's there. He's a scapegoat. He's an interim guy. Okay, he's not here to save us. He's the first non-English person voted into the to be the head of the Bank of England, because he's going to be a scapegoat, just like anybody they brought in after Alex Ferguson. Okay, until the inevitable, Jose Mourinho was brought into play. Everyone else really, was an easy scapegoat. They paid the money, but we didn't really think that these managers were going to replace Fergie, because he was just too much of a legacy. So he just comes again into the same thing with Mark Carney. He'll come, he will go. Janet Yellen will come, they will go. And do these people actually really see anything through? No, not really. So we can't rely on everything these people say. They have very high positions, they have very high opinions of themselves. But if you kind of tell me it's something as complex as the UK retrofitting all its previous policies and again, the ramifications on the economy to jobs, etc. If you're telling me that Mark Carney knows the exact outcome of this, it's just a lie. He just doesn't. It's as simple as that, because there's nobody does really. So again, when we talk about the UK, the Bank of England, that's very UK centric. When we're talking about the bigger picture, we're generally talking about what's been said from the Fed. So the Fed, the Federal Reserve System, the governor of the Fed is Janet Yellen. So essentially, apart from Obama, she's probably the most powerful, influential person in the world, because she dictates policy. Every time we talk about interest rates, the world will listen. Now, Obama's obviously a figurehead, and he's the leader of the free world, but it's really the kind of the money men, the guys with the checkbooks that really control how things are done. So certainly in trading terms, you'll want to be listening to Janet Yellen over Obama, because Obama, again, is the one that delivers these messages. He's not the one that kind of comes up with them. So as I say, when you're talking in traded terms, you're talking about people that move the markets, people that are important to listen to, what's important from traders speak. Well, then it's these guys, it's Yellen, Fisher, Trullo, Powell, Brainard. And, again, it's when you're listening to the news wires, or you listen to a squawk system, or you're reading the papers, it'll be, Fed member Yellen says, this, or, Fed's member Powell says this. They don't come out and give you an explanation of who these people are. And that's, again, another way of understanding how this news is delivered within the markets. You're expected to know who these people are and what they say, what their stance is, and what impact what they say can have on the markets. So if you know that Janet Yellen is very hawkish on rates, and she suddenly comes out and makes dovish comments that rates might be able to to stay on hold for a bit longer or come down, then you'll know if that's what the market has already priced in or is expected. Now it starts to get a little bit complicated there, but it's not rocket science. If Janet Yellen, her major job is to put interest rates up, she has said previously last year that this year there would be 4 interest rate hikes. Now, if there's 1, that's not as good, is it? If there's 2, it's not as good. But it depends how you view it. Is more rate hikes to normalise the economy actually good? Does that mean the US economy is doing better? Or does more rate hikes mean that the effects of QE will start to be eroded, and actual in real terms, higher interest rates are bad for the economy? Well, again, this is the decisions we have to make. So trading terms, what he said changes constantly, but the actual nuts and bolts doesn't. When we're talking about the economy, we're talking about who is saying things, who's delivering these messages. They don't change that often. The way they say things, the focus of traders, that will change month in, month out, and always will, depending on an inflation cycle, the growth cycle. If we're looking at rates or we're looking at growth data, that will change, because it has to change so newspapers can sell money, and Bloomberg, Reuters can make money from their experts, having their analysis. But in real terms, when we talk about economic cycles, we talk about the nuts and bolts, it doesn't really change. The kind of people we talk about, the institutions we talk about, the policies and the policy makers that we speak about, they're pretty much set in stone. They don't change that often. So when we're referring to things in America, we'll generally be talking about things like the FOMC. So that's the Federal Open Market Committee. So it's a branch of the Fed that deals with interest rates, QE, monetary policy. Okay, all them good things. So when you're listening to Janet Yellen, who heads up the FOMC, then anything that comes out of that can be big. So it can be do with more helicopter drops, or more interest rate hikes, or less interest hikes. Their opinions on growth, their opinions on the world economy, etc., etc. That's what traders listen to. So just there and there again, we've talked about QE. Until 7 or 8 years ago, we didn't know what QE was. It was a new measure, but it's quantitative easing. So an unconventional monetary policy used by central banks to stimulate the economy. So that's what we're talking about. Quantitative easing has been and gone in America. We're still doing a form of quantitative easing across Europe and the UK. And we call it different things. We call it the asset purchase facility in the UK. Yeah, what does it mean? Well, it means basically central banks put money into the economy to keep it ticking over to try and stimulate growth. So again, another complex term that's banded around a lot in the papers, but it's quite a simple explanation. I mean, how it works obviously is a lot more complicated, but in its essence, it is using money, okay, that, basically the Treasury writing a blank check, placing that into banks to try and stimulate growth. So again, not very, very complex. Then we're talking about, again, following off the Fed, we're talking about bias and inflation. So inflation, this is a difficult thing. We're getting more back to the economic type piece of information. And inflation is what it is. Inflation is the cost of money over time. Okay, so the Fed has a responsibility. Most central banks have a responsibility to stabilize inflation, and that's why that's how economies work. But unfortunately, inflation is generally controlled by interest rates because we've had low interest rates for so long. We've really battled to understand that relationship between inflation. So again, all these things will lead the central banks and the policymakers into different decisions. Looking at the Fed, they're tackling inflation, and looking at the Fed how they control interest rates. Then we've got things like the discount rate. Now that is the interest rate charged to commercial banks or other institutions on loans they get from the Fed. So again, it's another thing that we talked about on and off, over the years. There's one interest rate for you and I. If we go down to the bank, we'll get charged, loans at a certain rate based upon the other core interest rate. And when we put money into the bank, we will get interest based around, that interest rate. And everything kind of flows off that. But there's then the discount rate, which means banks that borrow money off each other in the Fed, are charged a different rate. So again, it's just understanding that the high street, the retail side of it doesn't work in quite the same way as the professional side. So then we've got federal fund target rate. So that's a short-term interest rates bank charges other banks to borrow money. So again, another thing that we can keep an eye on. If there's a change in the Fed funds rate, that again could eye up that the actual interest rates, for normal people could eventually be on the horizon of changing. Then we have things like economic figures, so GDP. So the gross domestic product is just a broad range of what a country produces, and its labour, its property, etc. So that's the primary measure of US production. So the GDP is another signal of how strong a country is doing. Good GDP, country's doing well. Bad GDP, it's not. Stupid slide. Then we have things like PCE, personal consumption expenditure, so a measure of the goods and services purchased, prime rate. Again, more banking terms, where interest rates are changed for banks' best customers. So again, this is how complex the world is. When we talk about interest rates, we're not just talking about your average man getting his current account at Lloyd's. We're talking about preferential billionaires. We're talking about companies and huge balance sheets. People that have just more money than the average will get different treatment. Then the technical side is moving away from all those things. So the technical side is much more coming back to all the ideas of finding value, looking at price movement, action. So everything that's in the chart. So you look at trend lines, indicators, oscillators, candlesticks. You'll look at support lines, resistance lines, all that technical side. It's still trader talk. It's trader lingo. If you say that that the FTSE is looking for a fundamental psychological level at 7,000, it means that the market's expecting something to happen around that level. Then price action, and again, there's a whole section in technical analysis about how we figure out what price action is, where value is, and that again is all the kind of technical side where you'll hear experts in the markets give their professional opinions on where value is, where support is, where the market's overbought, oversold, and again, it's looking for value. It's trying to figure out when you look at a chart if something's high or low and what relatively that means. So there were just two examples of how relatively simple, terms can seem overcomplicated in trading. When we look at the technical trading side, we understand that traders are searching for value and can use price action. But then we have to understand that, what these common traders use to find out what value is. You can't just look at a chart and say, right, okay, well, that's a lot of red candles, a lot of black, a lot of red candles, a lot of kind of green candles. Where's value? Well, the trader talk comes in that you're looking at your value with things like RSI, Bollinger Bands, moving average, candlesticks, candlestick patterns. This is technical trader talk. These are technical examples of what traders are looking at to find that value. So again, it's when you're trying to figure out value on a chart. If you're looking at an indicator, an RSI is an indicator. It's also known as an oscillator because it has a scale between 0 and 1 and 0 and 100. So in RSI terms, the market is oversold below 30, overbought above 70. So that should actually trade in range. That's your trend. So the common terms you're going to hear are overbought and oversold. So that's what the RSI is looking for, to give you a visual representation if the market's overbought or oversold, if it's high or if it's low. So again, if you look on the actual chart, how that pans out, then what we can see is that the market here is is going up. We break down. So what we're looking for is a change in this RSI to maybe give us an indication of what could potentially happen in the future. Well, the market has rejected going up here, so it starts to come down and trend down. But this here, the 70 mark and 30 mark, are the overbought and oversold regions. So the overbought region here, 70, as the RSI moves down, okay, that indicates that this market is coming down. It's overbought. So that's another way of visually, seeing what the market's doing by using different indicators. And again, Bollinger Bands are the same. Bollinger Bands show you when the market is overbought and oversold by these bands here. They pivot around the moving average. So again, what you're trying to find is a point in the market where it can't go up anymore, where you get a confirming indicator. You're finding resistance on the upper resistance Bollinger Band here, the upper level. The RSI is over, bought here. So, if we don't know anything past the red line, what we're figuring out is we're looking for sells because the Bollinger Band's acting as resistance and the RSI is coming down, and that lets the market do its job and correct. Then the moving average. Well, the moving average is just that. It's a sample of data over a period of time. So when we're above the moving average, the market's going up. When we're below the moving average, the market is essentially selling off and going down. So what we're trying to figure out is, where are we in that point of time? Are we buying or selling? What is our trader talk telling us? Where people say, we're selling below the 20-day moving average, then that, again, you get on the back of that and you trade the short end of that product because the traders are talking about it going down. Then candlesticks. So candlesticks are one of the easiest ways to display any kind of data. So you see the high, the low, the open, the close, and green bodies indicate buying. Okay, red bodies indicate selling. So again, if you're looking for people talking about candlesticks, talking about the bodies, the wicks, the shadows, pin bars, overbought, oversold, you generally be displaying them on on these candlestick charts. So as the market peaks out here, and the trader talk, is saying that we see a breakthrough candle that breaks and closes through the moving average, sending the market down. So that'll be a point of interest. That's trader talk here. This action of where the moving average does the opposite of what it used to. Then candlestick patterns, again, something else we'll hear: clusters, formations, individual candles. So this particular candlestick pattern here, we see a gap. We see the market break down. So we have a gap in the prices and the market continues down. So again, talking about gaps, talking about bullish, bearish reversals, individual candles, cluster patterns, etc., are all really, what the market traders are trying to, they're trying to, gain the upper hand, or they're trying to gain some sort of idea that they can portray to the market that something's happened for a reason. The market is sold off now because we've seen a gap. So that gap could have been news. That gap could have been a technical selling point. It could have been a big block trade. But however, what it does, it sends the market down after that gap. So that gap, created a talking point for the market. So when we talk about economic and political things, these are things that are being dreamt up by the media lobbies and by famous economic speakers. We've got things like the Fiscal Cliff. So whatever happened to the Fiscal Cliff? Do you ever see the Fiscal Cliff? No. Well, 5 years ago, that's all we were talking about. We were actually going to fall off a fiscal cliff where the economic policies were leading us into sudden severe economic decline. Then stagflation, again, something else that never happened. Persistent high inflation with high unemployment. We haven't come across stagflation yet. Not saying we won't, but these are things that are meant to terrify us. Then Doubledip Recession. Technically we didn't go into Doubledip Recession in the UK, but we weren't far off. And then, again, things like the debt ceiling, where the governments, like in the US, come to a grounding halt, to a standstill because they can't raise the debt and they can't pay the public sector. So, all these things have happened and mentioned, but it's all putting it into trading context, figuring out, do you buy the dollar on that? Do you sell the dollar? Or do you sell the S&P on this kind of news, this kind of information? Really, the main reason that the press use terms, like fiscal cliff, etc., to put fear in us. So the Brexit campaign is a prime example of fear. George Osborne's come out and says that house prices might drop 10 to 18% in the UK if we leave Europe. How he's come up with these figures, I have absolutely no idea. But he's George Osborne, he's the Chancellor of the Exchequer, so he says it It's there. So what are people in the UK going to do? I don't want my house to drop down 20%. Let's stay in the euro. I don't really understand what staying in the euro really means. I don't really care, but I'm frightened. I'm frightened of my house not being as worth money as what I think it is. So there we go. Newspapers bring up these terms to sell papers and to make money. So when you know about these things, you can build up your own opinions, because just because the sheep and the masses jump on these things doesn't mean you should. Again, a lot of these terms that are released into the market, a lot of things that are said are old. They're old news. So when we talk about these things, they're not new ideas. New ideas always move the markets a lot quicker. So really, again, a minute is a long time in trading. So when you hear or anticipate big news, things can happen very, very quickly. But what happens quickly will reverse quickly. People build their opinions over minutes, they build them over hours, they build them over days, they build them over weeks, years. People have opinions over years. They will hold stock, shares, currencies, commodities over years. So what we're trying to do is figure out what will move markets the quickest, and that's new news. But then figure out that all markets move and have some sort of news based into them. Every chart you see that goes up or down, there'll be some element of news in that market. Okay, because markets go up, markets go down. All right, guys. Well, that's a bit of an informal kind of look into how we view lingo, how we break it down into the kind of economic side, the political side, how we break it down into what happens, from the from the traders involved in the markets, and it's not meant to be overcomplicated. It's not meant to kind of frighten you. What it is meant to do is build, just a little few barriers up now and again, just to kind of make people seem a little bit more confident that they understand things, so they know what they're talking about. At the end of the day, anything you do will have its own language in some way. If you go down to a football match, like I said, you'll need to know the offside rule. Doesn't mean it's the most complicated thing in the world, but it's something to listen out for. In economic terms, we have these different things from the technical and fundamental side, and that's what we're looking out to try and capitalize on. If anything new is said, then that can make us potentially, a trading call and make us money. All right, guys. Well, like I said, it's a bit more kind of a lighter side, or just kind of different way of thinking. All this information is on the internet, so anything you need to know, there are trading dictionaries. The Rough Guide to Trading has a lot of explanation about these things. My book on Amazon. And it's really just kind of not be frightened off by the so-called experts. Anybody who has half a brain, a little bit of intelligence, can figure out what the markets are trying to achieve and what they're trying to do based upon what is said, from these policymakers and what's said from the markets. All right, guys. Well, anything else? Get me on Twitter. We had to move this Thursday one to Tuesday because I'll be off to Vegas on Thursday. So that's pretty much me done for this month, and I'm going to go for my stag do, and I'm going to have a damn good time in Vegas. So if I make it back, there'll be plenty more webinars. If not, it's been a pleasure. All right, guys. Well, take it easy, and I'm going to speak to you all next week at some point. Okay, thanks a lot.